In a statement, Target says it's offered Pride products for more than a decade, but the response this year has been different. The kind Target lost $10 billion of market value.
Brace yourself as we unravel a financial drama at Target. This retail giant is now staggering under the weight of an unprecedented financial crisis. But what's pushing Target to the brink? Let's dive in. Growing issue of organized retail crime and its impact on Target. Target, the biggest store chain we all know, is dealing with a big problem that's costing it a lot of money: theft and organized retail crime. This issue is expected to reduce Target's profits by a huge $500 million compared to last year. In essence, inventory shrinking is eroding Target's profits. The growth in theft and organized crime against retailers is adding more financial strain on the company, with the predicted shrinkage set to lower profits by more than $500 million year on year. We will try explain the money impact of this problem and also look at how the company's been doing recently and what might be in store for the future. The main problems causing this worrying situation are theft and crimes against retailers that are organized by groups. These illegal activities are leading to more violent incidents in stores like Target, which can be dangerous for the people who work there and those who shop there. This problem is harder to manage with insufficient staff. Theft doesn't just harm the workers, it also affects the customers because there are fewer and fewer items available to buy, which can make them unhappy. If we don't deal with these issues, it could cause bigger problems in the areas where Target stores are located. According to a CNN report, losses from shoplifting and other forms of theft in retail stores, known as shrink, shot up to a massive $94.5 billion in 2021. This was 4% higher than in 2020 and a massive 53% higher than in 2019. On average, retailers saw a jump of 26.5% in crimes against them that were organized by groups in 2021. Between 2018 and 2020, the number of assaults reported to the FBI by the police went up 42%. They went up 63% in grocery stores and 75% in convenience stores. Target's security measures and collaborative efforts to combat organized retail crime. To deal with all of this theft, Target has to spend a lot of money on security and ways to protect their inventory. This added cost to increase operation expenses. This added cost could increase operating expenses, putting more pressure on profits. If spending all this money on security doesn't quickly reduce the amount of theft, it could continue to put financial strain on the company and might require even more spending. However, this problem is too big for one store to deal with on its own. So Target is working with lawmakers, police, and other people in the industry to try to come up with a solution that can help everyone. Target is not avoiding this problem, they are actively trying to resolve it. They are looking for solutions that will not only help their business, but will also benefit their customers, their employees, and the communities where they operate. So while Target tries to deal with theft, it needs to be careful not to scare off customers in the process. Financial analysis of Target amid rising retail crime. If we look at Target's latest quarterly earnings report, there are some important things for investors to note. The day after the earnings were announced, Target's stock price went up by 2.6%. This was probably because the company's earnings per share of the portion of a company's profit allocated to each share of the stock was 16.1% higher than what experts had predicted. Target did see an increase in revenue, money made from sales, compared to last year, but the growth was only about 0.6% to $25.3 billion, which was less than expected. Over the last 3 years, Target's revenue has grown at an average rate of 11.8% per year, but that growth seems to be slowing down. Experts predict that Target's revenue will grow by 1.2% this year, reaching $110.5 billion, and 2% next year, reaching $112.7 billion. This indicates that Target's revenue isn't increasing as rapidly as it used to. The company's gross margin, or the difference between sales and costs of goods sold, was 27%, but the operating margin, or the difference between sales and all costs of doing business, shrank a bit from 5.4% last year to 5.2% 8% this year. Over the past 3 years, Target's EBIT margin, or the difference between sales and all costs except interest and taxes, has fallen from 6% to 3.5%. However, despite this downward trend in the past, analysts are predicting that the EBIT margin will grow by 1.37% this year to 4.9% and grow again by 0.93% next year to 5.8%. This is good news, as it might mean the company will be more profitable in the future. In the past 3 years, Target's earnings per share, EPS, which is a company's profit divided by the number of shares of its stock, has been shrinking at a rate of -2% per year. But there's hope that this might turn around. Experts predict that Target's EPS will grow by 38.1% this year to $8.31, and by another 24.8% next year to $10.38. So even though the EPS has been struggling in the past, it seems like it might start to grow again. When it comes to the company's free cash flow, FCF, which is the cash a company generates after accounting for cash outflows to support operations and maintain its capital assets, there has been a noticeable drop over the past 4 years. 4 years ago, the FCF margin, which is the ratio of free cash flow to sales, was at 5%, but the prediction for this year is only 2.7%. While this is something to worry about, the company has still been able to maintain an average FCF margin of 4.2% over these last 4 years. Combined with a good return on invested capital of 9.5%, which is a measure of a company's efficiency at allocating the capital under its control to profitable investments, and a net cash position of $14.889 million. It shows that the company is in a strong financial position. Over the past year, Target's stock hasn't been doing great, falling behind the broader stock market by 11% and losing 2.2% in value overall. Right now, the stock's price is 6.2% lower than its average over the past 200 days and 18% lower than its highest price over the past year. But it's 10% higher than its lowest price over the past year. This might mean that the stock is cheaper than it should be, which could make it a good investment. Looking at various valuation multiples, which are the ways to estimate the value of a stock, Target's stock is currently trading at a lower value compared to sales, earnings before interest and taxes, and earnings per share than most stocks in the S&P 500. But when looking at free cash flow, it's a bit more expensive than most stocks in the S&P 500 by about 4.2%. If we look back at Target's stock price, the current price to earnings ratio, which is a measure of the price you pay for each dollar of the company's earnings, is 17.3 for the next 12 months. This is a little bit higher than the average PE ratio of the last 5 years, which was 16.8, but it's within the range of what's normal for this stock, which is a PE between 10.9 and 22.7. This means the stock isn't really cheaper or more expensive than it usually is compared to its earnings. Now, if we compare Target's valuation to other companies in the same industry, we find some interesting things. Walmart, Home Depot, and Best Buy have PE ratios for the next 12 months of 23.6, 19.3, and 11.4 respectively. This means that for each dollar of earnings, investors are willing to pay more for Walmart and Home Depot stocks than for Target. On the other hand, they are willing to pay less for Best Buy. With its PE of 17.3%, Target is right in the middle, suggesting it's priced fairly compared to these other companies. Future outlook for investors considering Target's stock. If we sum up our thoughts on Target's recent financial performance, it's a bit of a mixed bag. The company's growth has slowed down and the stock hasn't done great in the last year, but there are also good signs. Analysts expect earnings per share to grow. They think the company will be able to keep more of each dollar of sales as profit, and the company has a strong return on its investments and a solid financial position. Plus, the stock seems reasonably priced, especially as the company's profitability is expected to improve. The stock's current price also seems attractive for buying, as it's lower than the average over the past 200 days and not much higher than its lowest price in the past year. Given these reasons, we think it might be a good idea for investors to add Target stock to their portfolios. As Target navigates this daunting financial crisis, the only question lingers is, will they be able to rebound or surrender to the pressures of retail collapse? What do you think? Let us know in the comments.